Well, good evening, everybody. This is Paul Horsley and Dave Forbes with your IBC Money Monday. We appreciate you being here and want to thank you for joining us tonight. We've got some pretty cool information to share with you. Dave's been slaving away at the computer all day, just putting this special program together for you, and he can create some amazing things like you're going to see tonight.
I just wish I didn't always feel so confused.
Yeah. Oh, stop. Confused.
I am confused sometimes.
Oh, well, take it away, sir.
Anyway.
Yeah.
Well, welcome everybody. Thanks for tuning in for Money Monday Think Tank. That's what we've decided to call this. I just want to give a little shout out. Paul's been a great mentor of mine. I'm just happy that we kind of decided to do this and did the work to do it every Monday night. Last week we mentioned that we've got a new website. We had spent a little time and effort and redid it. Over the last week, I have reposted all the videos from these Monday night sessions. And so they're up on our website. It's kind of hard to find. We tried to make it as clean looking as possible. And so what you need to do is scroll to the bottom of the homepage, and down at the bottom will be resources. And we have just one resources page, and it branches off into all the educational stuff we have. One of which is videos, these videos, plus some videos that we got permission to use from Nelson Nash's organization, and then some other things. Also on there is a link to the banknotes. The infinitebanking.org, the Nelson Nash Institute, puts out a monthly newsletter called Banknotes. And there's some really good stuff in there, some deep dive into some subjects that we just don't have time to cover in these sessions. Also, there's some interviews from the past. A lot of it is written by Carlos Lara and Robert Murphy, who are two of Paul's and my mentors at infinitebanking.org. They also do the Lara Murphy Report podcast, which you think we get nerdy, you should listen to theirs. Economists talking about Fed rates and coming recessions and things, but it's actually some very interesting stuff. Bob Murphy is one of the funniest economists you'll ever meet. I know that's kind of a dichotomy, but it's true. Anyway, take a look at that stuff. If you can't find it on our webpage, or you don't want to, or you're always on YouTube, we do have a YouTube channel. Sure. I post these things right, sometime within a day or two after we have these Monday night meetings on YouTube. They're there. Just search for Financial Prodigy, and you'll hit our channel. I also gave you some links in the emails I sent out, and then also we've got a Twitter page, a Twitter feed, a Facebook page, and a LinkedIn page to make the full circle. And if we add anything more to it, we're going to have to hire a social media person to take care of things. But that having been said, have a chance to take it out, check it out. I try to get an email out after these meetings. I got busy last week and I didn't, but it's there, and I left the links in the emails from yesterday to go take a look at it. So tonight we've been working on Nelson Nash's book, Becoming Your Own Banker. Even if you are a newbie and a rookie at this, or if you've been studying this stuff for years, there's always little gems and jewels found in that little book that we actually read it. When we read it and read it over and over again, we're like, oh my gosh, I can't believe that I haven't read that before. I showed last week what I actually did, and it's just because I'm a total nerd, is I took it down to Office Max and I had it bound and covered. I'd gone through about 4 books where you'd bend them out and the pages would start falling out and I'd lose all my notes. And so I basically took it and got it bound. It was $5, best $5 I've ever spent. And now it's on a spiral bound notebook for me and I can work on it. But anyway, he starts out, a lot of Nelson's stuff, and this is more of a book review, is higher level. And sometimes it's so high level, it doesn't make sense when we're trying to figure out the nuts and bolts of how infinite banking works. So we're going to go over this week and for the next few weeks and just kind of take the book in small and medium-sized bites until we get to the end. And then we get done with that, we may start in on Paul's book, because Paul's book fills in a lot of those gaps. So from there on out, we're going to just take a look at this piece by piece. We may have a couple of guests thrown in over the next few weeks. Paul and I are working on some that have some very interesting insights to infinite banking, both as users and other infinite banking practitioners who have taken their business in different directions and have different kind of customers than we have, and talk about it. On that note, Paul, can you share? Do I get to share my screen? Have you got me set up?
I'm just a little bit slow on that, but I'm getting.
I know. I'm sitting here blabbing away, hoping you'd be anticipating.
I know, and you had to once again get on me for that. So yeah, that will be the last time.
It's all right. For those of you who aren't in the flying business, whenever you're just sitting there staring out the window, the whole motto is you should be thinking about what you're supposed to do next, because you should be doing something.
Dave is so right.
But with COVID, none of us have flown for a while, so Paul's obviously needs to get back in the cockpit and play around a little bit. So
thanks, Dave.
I'm
love
just
you, man.
saying. I'm giving you.
I told
grief,
you, everybody, you're gonna be very impressed tonight with what you're seeing. He obviously is.
Oh man,
I'm just a half a fry out tonight, baby. We'll see.
I know. All right. We've been talking about the problem, and in becoming your own banker, Nelson Nash stated that one of the main reasons why he got into this was there's a problem in the way that we're taught money. We're taught that you grow up, you do all these things, you save, and then with your savings, you buy things or you retire with your savings. But it's all based on savings, and we tend to worry about what the return we're getting on our savings is, with not really looking at the whole picture. And what Nelson is getting at is that the problem is we aren't looking at the whole picture. So in Nelson's book, it was written in 1999, and there are some dated parts of it. Amounts, prices of things, interest rates, and a lot of what stops people from doing the deep dive is they don't want to do the mental math to convert what he's talking about in 1999 to 2020. 1999, we had higher interest rates, but things were cheaper. 2020, things are a little bit more expensive, but we have, in some cases, negative interest rates or very low interest rates with no real indication on the horizon that those rates are going to skyrocket anytime soon. And so what I did is today I went back and I wanted to become as average as I could be. So I tried to find out the average things. And being average, what I mean by that is, what are the average things in the United States? The government produces warehouses full of data of averages. There's lots of data on the average family, the average male, the average female, and then you break it down by average family in age groups, average males in age groups, average females in age groups, average people in certain geographical locations, et cetera, et cetera. It's amazing what you can glean out of this stuff. But the one thing that you can do is, much of the average in a person's life, as it says here, is it's financial. And one thing that we always do, and that was taught, and it gets back to being the problem, is to do things in our life requires financing. Money runs our life. We get a paycheck, we pay taxes. What's left over after the taxes is what we run our life on. The problem is we're always paying interest. Even if we don't have loans out, we're paying interest if we're paying in cash, because we're using that cash and missing out on other opportunities that could have earned us interest. So when I say we always pay interest and it's perpetual, that's what I mean. If you have zero debt and you're of a certain financial guru that says zero debt is great, and then pay cash for everything. If you are paying cash for everything, you're losing out on other opportunities where you could have possibly been earning more interest than that money, than whatever you purchased was. Okay, so when I say interest is perpetual, I mean it that way, in that sense. One other interesting thing I found about being average is that almost all conventional financing, and when I say conventional financing, I mean financing that's through a bank or a finance company, is never paid off, ever. Credit cards are a perfect example of that. They call it revolving credit because you pay off a little bit, but then you take a little bit more out, and you pay off a little bit and you take a little bit more out, and it revolves and revolves and revolves around forever. The same with mortgages, believe it or not. There's very, very few people in the United States that pay off their mortgages. The average person never does. And you say, well, he never does. How can that be? I'll get into that in just a minute. This was from December 2019, and it was the 2019 American Household Credit Debt Study, Department of Commerce. And if you look here, we've got the type of debt, the total owed by the average U.S. household with this debt, and the total amount owed in the United States. The first line there is any type of debt. And what that means is it includes mortgages, home equity lines of credit, auto loans, credit cards, student loans, other household debt. And the credit debt chart in this chart represent revolving credit balances carried month to month when we say credit cards. But any type of debt, the average household in the U.S. has $137,879 of debt. Total debt owed in the United States right now to banks is $14.15 trillion. And if you go back to what we talked about a couple of weeks ago, the banks aren't using their own money. They're using our money that we deposit into banks as quote unquote savings accounts to then roll out on a 10-to-1 ratio to take on new debt. So if you look at just what you're looking at in terms of the money made by the banks on a $14 trillion debt, it's astounding. Revolving credit cards right now, the average household revolving credit card, your MasterCard, Visa, American Express, Discover card, the average house, every house in the U.S., $7,100 of credit card debt at very high interest rates. Mortgages, the average mortgage in the United States, $192,000. Average auto loans, $27,000. The average student loan is almost $47,000. It's incredible.
Nelson always said, banks don't lend money because you have a piece of real estate or you want a car. They lend you the money because they think you can pay it back and make them money through the interest.
Yeah, exactly. So anyway, it was kind of an interesting thing. So to be more average, I came up with Sam. Meet Sam. Sam is your average 29-year-old American male. Okay. I mean, what does it mean by Sam's being average? Well, Sam's a good guy. He's 29 years old and is average. He makes $49,648.75 a year. Sam's got to pay his bit to the government. He's got to pay his state tax, his federal tax. He's got to pay his Medicare. He's got to pay his Social Security. So Sam loses about 20% of his salary to taxes, which means he takes home $339,719. Sam thinks he's responsible because here's why. He has a house. Sam bought a condo, okay? And he's making the payments. He owns his house. He has a car. He has a college degree. And he has credit card debt. But where does Sam's paycheck really go? That $39,000 and some change. According to the averages, the average percentage of a 29-year-old's paycheck that goes to housing, and actually this is almost the same throughout all age groups in the United States right now. Housing accounts for 37% of take-home pay in the United States right now. So in Sam's case, Sam was smart. He saved up some money. He put down 20% on a condo or a townhouse, and he got $150,000 more 30-year mortgage at 4%, which is today's rates for somebody at his age, and I'm assuming with an average FICO score below 700, okay, for that age group. His monthly payments, $716 and some change. He pays $208.33 a month in property taxes. He doesn't have any PMI because he saved up and put 20% down, but his household insurance is $1,000 a year or $83.33 a month. And since he is living in a townhouse, he's got HOA fees, that hidden cost of living in gated communities or places where where somebody else mows your lawn. The average for a $180,000 condo, HOA fee is about $200 a month. Sam was really smart. What he did is instead of buying a brand new car, he went out and bought a 3-year-old Jeep CJ. It was $30,000. He put a little bit of money down, and he got a $25,000 72-month loan at 4.49%, which is those are the rates that are actual today. Also, just a little bit of trivia here: 59% of all car loans today are 72-month loans, 6-year loans on cars. And no one keeps a car for 6 years. But Sam was going with the flow because he's average. He took out his $25,000 at 6-year loan at 4.49%. His monthly payment for his car, $396.74. He's trying to be responsible, and the average maintenance cost of a car such as his is about $600 a year. You know, a few minor things and maybe a medium repair. So he's been putting away $50 a month towards maintenance. Insurance, because he's a male, $62.50 a month, $750 a year. Well, where else does Sam's paycheck go? Well, we saw 37% goes for housing, 13% goes for transportation, 40% goes to living expenses. And what the government claims as living expenses is everything except housing and transportation. So living expenses includes student loan debt, okay? Sam went to college and paid for some of it. His parents helped him out. But at the end of 4 years, he had $35,000 in student loan debt. That is the U.S. average outstanding student loan debt right now, okay? Student loans are also at about, actually that's an error. Student loans are at 5.8%. And his monthly payment for that is $385.07. Most student loans are on a 10-year term. Because he's average, he's got an $8,000 credit card debt. But look at the interest rate on that. Credit card interest rates right now are 19.02%. That's the average in the United States for a credit card. Comes out to $149.44 a month. That leaves him, and Sam's no slouch. He's taking home almost $40,000 a year and not living the high life. It leaves him $800 a month for food, fun, and essentials, $200 a week. What about savings? Oh my, Sam's responsible, or at least he thinks he is. So he's saving 10% of his take-home pay, which comes out to $3,900 per year. But he's earning 0.2% interest on passbook savings accounts right now. That's it. The crazy part is the actual U.S. average savings rate is hovering around 5%. It was a little bit below 5% at the beginning of the COVID, and it's a little bit over it now because nobody's been out spending money, so they're actually saving more money than they have in many, many years. But here's the problem, and this is Nelson Nash's problem, is how does Sam get ahead? I mean, I've talked this over with my kids. Paul, you probably have done the same with yours. And it's a dilemma. Because unless you are going to live an almost pauper-like existence on average costs and average income, it makes it very, very difficult to get ahead. Here's the hard facts. When we're talking about mortgages, and when I said almost no one ever pays off a mortgage, here's why. Most Americans move every 5 years. So they take out a 30-year mortgage, they start paying on it, they pay the closing costs, they pay the points, they pay the fees, and then they start paying on their mortgage. And 60 months later, something in their life happens, a job transfer, more children where you need more space, your income goes up, so you think you need a bigger house, and they move up. But here's the crazy thing, is that the 5-year cumulative interest at the 5-year point is $28,638.65. The balance after 5 years on this $150,000 note is $135,671, okay? Which means Sam has paid $28,000, almost $29,000 in interest, and he's only paid down a little over $14,000 on the principal of his note. And now he moves up in the world, buys a new house, a bigger house. Maybe he'll use the equity in his house to buy 20% equity in the new house, but he gets a new mortgage. He pays more points. He pays more origination fees. He pays all the other stuff, and he starts the whole process over again, never really getting ahead. Here's some more hard facts. Most Americans never pay off car loans. Like I said, almost 60% of all car loans today are 72-month loans. They're 6-year loans. The average person trades out their car every 4.5 years. And if you talk to any car dealer, and Nelson uses it in his book, and it's even more so today, that you've got people coming in after 4.5 years ready to trade up or trade into a new car, and they're currently underwater in their car. They owe more on their car than their car is worth. But they don't look at it this way. Car dealers sell based on monthly payments. How much? First thing they ask you if you go look at a new car, how much can you afford? Even a used car. How much can you afford per month? And I can get you in a car for $299 a month. And you're like, great. And you have no idea how much you paid, what your interest rate is, and where this money's going. And that's what happens every time. Car dealers, their main business outside of selling cars is financing. They make so much money on financing. They get a kickback from the loan. They get a percentage. They want you to take out a big loan. So if you look down here, I just did a real quick loan amortization schedule. The average car loan is 4.49% right now. Okay. So if Sam were to buy here's Sam's car he bought for $25,000. At the end of 5 years, Sam has paid $3,451 in interest. And he's paid down quite a bit of this car because it's at 5 years of a 7-year loan, but he still has a $4,600 balance on his 5-year-old car. And I'm pretty much guaranteeing you that a used Jeep CJ that's 8 years old, because remember we said he bought it was a fairly new 3-year-old thing, is going to be worth less than $4,600. So he's probably going to be underwater in this loan when he gets done. So he's going to have to kick in more cash and take out another loan to get another car. It's just crazy. We ask, will Sam ever get ahead? Well, if he gets Nelson Nash's book and reads Becoming Your Own Banker, he may. It's a long process. I use this picture because I'm a big Jetsons fan, but I always used to laugh that, when you're in something that you can't seem to get ahead on, I always think of George Jetson on the treadmill. and Astro's sitting there watching him spin around and around and around and around. And what I say here is what we do is we focus on rates, but we ignore volume. In terms of when we're standing around, we're always with our friends, we want to talk about, you know, what rate we're getting on our CD, what rate we're getting on a savings plan, how we did with our investments in the market, which may only make up 7% of our salary. But we're always thinking about the rates. Oh, I earned 13%. I earned 15%. But ignoring the volume of money that is flowing outwards in interest in our everyday life. And that's what, when the light bulb went off in Nelson's head and he started writing this book, that's what it was. It was, oh my gosh, if I could recapture somehow this volume of money that's flowing out to the banks and never returning to me, what a powerful thing that would be. He used the medicine analogy where he said, you know, it's not the rate, it's the volume when you go to the doctor. If the doctor's got to give you a shot, it's not how fast he injects it into you, it's how much he injects into you. You know, too little and he won't cure you. Too much and he may kill you. But the problem there is it's not the rate at which he gives it to you, it's the volume, it's how much. And what we tend to not look at is we look at the rate that these ancillary bits of money are earning and not where the volume of money is really going. Average Sam, which is the average American right now, 26% of every dollar earned after taxes goes to pay interest. And that's average. And there are certain demographics that actually even pay more than that. It'd be a pretty powerful thing if you could recapture 26% of your after-tax income and still be able to use it for things. So do we really care about what the rate is? We really don't. What we want to do is have a plan in which we can recapture that outflow, that volume of outflow, and make it an inflow to us. And over and over again, Nelson always said, got to change your thinking, got to change how you think. And I have to admit, and Paul will admit it too, it took me a long time. I was a student of the markets since college. I did my senior thesis on butterfly options and iron condors. I mean, I love that stuff. And to me, it was like, well, of course, I'm going to sit and trade or invest. And over the years, I realized that it's a fun hobby and it keeps my mind sharp, but it's not a way to make money. It had nothing to do with the volume of money that was coming in or out. I'm doing all these things with this little tiny account off on the side and said, oh, I made 33% over the last 2 years on my trading account while I watched my mortgage payments go out, car loans go out, other things go out, and never realizing what the volume meant. I like it. Wouldn't you rather have a return on all your savings accounts, on your savings account, or all that interest working for you and not others? And that's the thing, is the interest that we pay out is not working for us anymore. We basically become just a pass-through entity to bankers that we earn the money, it passes through us and out the door to them, and we never see it again until we have to go to them and basically ask them to borrow our own money back at a higher interest than they're paying us to deposit it. It didn't make sense. It didn't make sense for Nelson. It doesn't make sense to any of us. And that's why we're all sitting here on Monday nights talking about this. I love the quote that wasn't Nelson's, but it was a friend of mine. And he called infinite banking the proverbial sweatshop for dollars. And what he meant by that is it all related to volume. Is you get a dollar and you put it to work. You put it to work paying down debt. You put it to work at the same time earning interest in another account. Or if you're not paying down debt with it, you're using it in another area to earn a return on your money that is greater than the interest that you're earning when it's sitting there. The greatest thing about this is with infinite banking is your money is always earning interest, even when you're using it somewhere else. It's just doing the math to make sure that whatever you're using the sweatshop for dollars is a positive thing. To wrap this up tonight, those of you who aren't pilots, you hear Paul and I and Brad and a few of us on here who are pilots talk about things that we do on in our airline jobs. And one of the things we always did, Nelson was a pilot himself too. He was in the Alabama Air National Guard and just loved flying. Paul actually at one time got him into the 777 simulator down in Atlanta. I think that was the highlight of the year, and he never stopped talking about that, Paul. That was awesome that you were able to do that. But what Nelson talks about at the end of The Problem in his book is headwinds and tailwinds, and what it means to our money. And having the ability to sit on your money and have it earning compound interest day after day allows you to avoid the headwinds and take advantage of the tailwinds. What do I mean by that? Well, he used the example is he's in Birmingham, Alabama, and he wants to go to Chicago. And he's got an airplane that goes 100 miles an hour. But he looks at the weather, and a big high pressure has moved over the area between Birmingham and Chicago. And right now, the headwinds going to Chicago are 200 miles an hour. Well, if he took off from Birmingham with an airplane that only goes 100 miles an hour into a 200 mile an hour headwind, would he ever get to Chicago? No, he'd probably get to Miami because he'd be going backwards. You know, he'd be going ahead 100 miles an hour, but still going across the ground negative 100 miles an hour. But that high pressure moves through, it moves off to New York, and you're on the back side of it. And now all of a sudden, you've got a 200 knot tailwind going to Chicago, and you hop in your plane and you're going along at 100 miles an hour, but you've got 200 extra miles an hour pushing you from behind, and you're getting 300 miles an hour off over the ground. And that's what he meant by a financial tailwind, is you sit and wait. And if there's a financial headwind out there, if it doesn't make sense, if my money is sitting there earning interest day after day and an opportunity comes along, but I look at it and I say, that is the equivalent of a financial headwind, I'm going to wait because it'll move through and something else will come along. And if it's a financial headwind, it means if you're going to take your money out and put it into something that earns you less, well, that's silly. You're going to lose money. But if you wait, there will always be an opportunity of something that will give you a financial tailwind. And that's the time to take your money, you put it to work, and it earns with the tailwind and also earns while it's sitting in your infinite banking account. And so the tailwind is something that you're always looking for the tailwind. And when I've always say the and asset, it's because you want to take your money, your volume of money that you're slowly transferring away from interest payments into infinite banking. And then when the opportunity comes, you're going to have your money working for you and something else. And it's all based on volume. The hardest part of this, and I know Paul yells at me when I say hard because infinite banking is easy once you get the hang of it, is patience. When you're starting an infinite banking program, there's a little bit of a wait time. You put in some money and you don't see the returns for a while. You've got cash value that you can use right away, but if you look at what you put in, you're buying death benefit too, so your deposits aren't equaling your cash value for a few years. And depending on your age, it just depends. It tends to catch up anywhere between year 4 and year 7. But after that, it's after year 7 that the tailwinds really take effect. And for every dollar you put in, you're getting $1.50 or $2 of cash value out of this that is able to turn right around and invest in something that'll even give you more of a return, which creates an even greater tailwind. And before you know it, you've got a 300 mile an hour tailwind. And on that note, that is the problem. And next week, we are going to solve the problem by setting up an infinite banking system. So,
very nice.
Any questions?
This is Mark. I just appreciate the sort of bringing it down to the common denominator. That I think that really helps to not simply understand it, but also understand how it's going to be applied.
And Mark, next week we're going to get a little bit more into depth of how an actual infinite banking policy works, how we start out with deposits, create the little tailwind to begin with, and how we use it, the nuts and bolts, the ground level, so to speak, of how you make it work for you over time to create that tailwind. And it's a very incremental process. And that's why when we were talking about this today of getting this presentation together, Paul and I get so excited about this, like, oh, we should do this, and we should do this, and we can cover 10 pages of the book. And I sat down in the book and I'm like, we need to just talk about the problem, and we need to update the problem to today's numbers, because that's something that hits home for all of us on a daily basis. And the whole idea here is if I can get all of you thinking about volume rather than rate, we've succeeded in this 45 minutes we're spending together. And then next week, we're going to see what we can actually do with that volume. But thanks, Mark. I appreciate it. Well, anyway,
it's true.
Any other questions, you guys? And if you, in between times, I purposely, when I send out the emails for these Monday night meetings, right on Monday night, you get one at an hour before and another one at 15 minutes before. The one at an hour before, I believe, comes from me, and the one at 15 minutes before comes from Paul. So you have both of our personal emails. And if it's not that one, if you want to use info@thefinancialprodigy.com and you've got a question, you don't want to ask it in a group, email it to one of us and we'll address it at the next meeting, our next meeting. That's why it's called the think tank. I almost prefer the written one so I can ponder it for a while to come up with at least somewhat coherent answer. So, okay, let's wrap it up, Paul.
Okay. Well, thanks everybody for joining us tonight. Dave, thank you. And
Thank you.
We'll see everybody next week. And please don't hesitate to share this with your friends.
All right.
Take care.
Thank you, everybody. Have a great night.
Bye-bye.
Thanks, Dave.
Thanks, guys.